All right. Well, I am super pleased that y'all could join us today on our mastermind call. It's June 19th, and this is our second mastermind. I posted into our newly created Facebook group that the purpose of today's call is supposed to be around masterminding net wealth strategies, figuring out what is the definition of net wealth in the first place, and why do we really care about tracking and improving our net wealth. And I know a lot of us are at different places in our lives for whether or not we have a financial background or not. So if at any point I'm talking over you and you know something, then just stop me. But really, what I want is for this to be collaborative. So last week we really harped on the differences between income and net wealth, and the idea around net wealth is that it is the accumulation of the income that you've earned and that you've really chosen to hang on to and invest. And at a high level, the reason that we care and should pay attention to our net wealth is that it is the true indicator of when I think you would actually be able to kind of cut the engines and not be dependent on an annual income to live, right? And so what I've noticed predominantly is that most of the time in our agent community, we're tracking deals on a monthly basis. We're looking at what we're earning, monthly, weekly, like what's pending. But the second part, and arguably the most important part of that conversation, is what are you keeping of what you earned? And the accumulated keeping of your annual income is what ultimately is going to drive your ability to improve your net wealth. So initial thoughts, reactions to that idea, or is that something that y'all are hanging on to yourselves? Have you been working with that purpose so far?
For me, recently, it's just tracking. I don't even know where I'm at, and tracking monthly expenses and looking for patterns there.
Mm-hmm. So more on the income statement side of the conversation instead of on the balance sheet side of the conversation?
Yeah, I want to look at the income coming in, what's going out, and then, well, my wife gets all the bills paid, but I want to start taking the extra money. She puts it away. She does a good job, but really just be more purposeful about it.
Okay.
Yeah.
So Sheila, we've got the benefit of a smaller call here. So have y'all, like Sheila, Raquel, Linda, have y'all taken inventory, I suppose, or have you looked back at your annual or monthly spend against your annual or monthly income and kind of assessed that so far?
Yes, I have been doing it with my MAPS coach. Going over those back profit and loss statements and kind of comparing them going forward, and also looking at my multi-year trend. So I am a little bit behind this year. However, I have more because I've cut so many expenses. When COVID happened, I'm actually, definitely in the black versus the red, since I've cut a lot of expenses.
And so when we're talking about, just so we can go to a high level overview, when we're talking about income and expenses, that's in the moment, that's right now. Whereas net wealth is the sum total of the habits that you've created for yourself over your working years, right? So annually, your income versus your expenses, hopefully at the end of the year, leads to a profit, and that profit that you then choose to keep and not spend is what grows your wealth over time, right?
Correct.
So the reason that we try to look at income and expenses every single month is to keep us honest on not running a negative profit or going into the hole. And that's a really great first step. And then, of course, we want every month to be profitable. We are in real estate, so we know sometimes that's not the case. But we want the accumulated effect of the year to be profitable, such that we can take that income, the business income, and allocate it into different places that allow you to improve your net wealth. Does that make sense? So the income and expense side is one portion of the conversation, and I'm seeking to get us to talk about how that can filter into the other part of the conversation, which is what I call our balance sheet, which is all of our assets minus all of our liabilities, which is equal then to our net wealth or the equity that we really have, the ownership of the things that we have chosen to keep. Does that resonate? Okay. Hey, Sheila.
Hey.
So
I actually just worked on mine today because I've been listening to the Ben Kinney podcast, the Wealth Series. And so I have had an account with mint.com forever and just never really used it. So I opened that up this morning and I linked all of my accounts and I was pleasantly surprised.
that's great.
At the net wealth. And so it's not something I've ever really done. So all of this is new to me, but I'm super excited and love looking at the numbers and seeing what I can save and trying to figure out what all these terms mean. So I'm excited.
That's fantastic. I'm really glad to hear that. Because everybody needs a place to start, right? So mint.com is great for what you just mentioned. It's great for tracking the income and the expenses. And the income and the expenses, the accumulated effect of those decisions leads to your profit, and your profit annually is what grows your net wealth, right? So does that, Linda, where are you at in this conversation so far? I know you work with a financial planner already, right?
Yes, and I would say that from the standpoint of, I guess, managing the expenses, I think that's something that I've always been pretty good at, and I think in working with my coach last year, almost too good at, because I wasn't spending money.
Well, you and I have that in common.
Yes.
Yes. Linda's got a very crude joke that probably isn't appropriate for a recorded call, but Linda likes to hang on to her hard-earned money. And that is something that we have held each other accountable to over the years. So you not only have been tracking your annual income, but you've also been tracking your annual growth of the total things that you own against the total things that you owe, correct?
Correct.
All right.
Correct. All, and pretty much all cash basis, and have been that way for a while.
Okay, so you said cash basis. You're talking about cash basis of accounting, right?
I'm talking purchases. So no credit at all is used.
Gotcha. Okay. So thoughts on that so far? Have Raquel or Tyler or Bob or anyone else on the call, have y'all looked at or taken the opportunity to make a list of all of your total assets, everything that you own, and then comparing it against your total liabilities? Have you done that yet?
Yeah.
I am working on mine.
Okay, awesome.
You know, one of the things that that I wonder about is for cars, when you have a note on them, how do you figure the value of a car? Because you don't know what it could sell for. So
right.
you've got to have the value of the car minus the loan that's left. And so, I mean, obviously you can find out what the loan is, but you don't know what the value, how to assess the value of the car.
Sure. Yeah. You know, I think the salvage value is probably, what I would assign to a car. Andy kind of laughs at me because when we look at car notes, I'll add the liability to the liability side, like the car note, but I won't add anything as on the asset column for the car itself, because to me it's depreciable. It just goes to zero essentially, right? And so that's been my approach, but I am hyper conservative with calculations with net wealth. The reality is that whatever you're driving is worth something. But to your point, it's highly likely that whatever you have in value on that car may be less than the note that you owe on that car.
Yeah, I've thought should I just make it a wash, meaning don't count the liability, or count the liability but count an equal amount as the asset.
Yeah, I mean that's essentially what I've done.
Yeah.
If not made it less of a wash and more towards the negative side of that discussion.
No, I'm really excited about trying to figure out my net worth. So it's something that I've been listening to all the WinMake
the WinMake Give series.
Yeah, videos, and it's got me really excited. I saw something recently about let me see if I can remember how it was worded. It was something about having goals, but if you really track your goals, it makes you excited every day of your life because you want to see what kind of progress you've made.
Totally.
And it's hard to take that with real estate as far as, okay, my goal is to farm my neighborhood once a month, versus money goals are something you can really see, you can really touch, you can really say, I am making progress or I'm falling behind.
Absolutely. And to Bob's point, what I found that I do is when I'm excited or if I'm feeling positive about the way in which things are going, like if I feel like I'm making money and I'm not really spending a lot of money, I am in that net wealth calculation constantly. I'm looking at my accounts, I'm looking at the investments, I'm looking at our cash balance, and I know what I owe. You know, it's our mortgages, and it's we've got a car note. So I know what we owe, and so it's very easy for me to do a quick back of the napkin calculation of total assets minus our notes and get to the net wealth. And so when things are good, I feel really good about checking it. And honestly, in the last 3 months, it's been depressing. And it's not something that I've visited probably as frequently as I should have. So this whole exercise has forced me to take inventory. So does anyone else feel that way right now?
Kind of like the scale. Like,
yes.
when you're eating healthy, you want to get on the scale. When you're not, you want to avoid it.
Totally. And you know what we did, we had all of our retirement assets are invested in, you know, either mutual funds or index funds or, you know, something like they're in stocks essentially. And because we're on the 30-ish, we're 30-ish, and the best advice is that your asset mix for any investments should be heavily in the equity, you know, stocks conversation versus being in stable earners like bonds or certificates of deposit. And I will tell you that we made the decision to pull our money out of the market in late 2019, I believe. And I felt personally uncomfortable with the way that things were going. Not to go too far off on a tangent, but there were a couple of markers that flashed in 2019 that to me said we're going to have a shift. And I didn't know how it was going to show up, but we moved our money out of the market. Well, I felt real stupid for all of January, all of February. I felt kind of okay in March, you know, but the market has bounced, and guess what? We did not reinvest. And so part of the reason that I haven't gone to look is because I don't really want to see it. But you know, that's got limited value as well, right? At a certain point, you've got to get used to the idea that there is embedded risk and, you know, move forward. So Tyler asked me what I'm using to track our net wealth. I use a spreadsheet. So we use a spreadsheet, and Ben Kinney on the WinMake Give series kept pointing everyone back to his website with resources, and he's got a really cool website up. So if you go to winmakegive.com/resources, I linked that in the Facebook group. He's got a downloadable Excel spreadsheet that actually turns what you enter into a graph where you can visually track it, which is pretty cool. I've used a spreadsheet that's far less sophisticated, where I just keep track of what we own and do it that way. So I just log into the accounts and I take a look at them and go from there. Little Lucky's having a hard time over here. Can y'all hear him? Sorry. So
Carolyn, do you do a balance sheet as well as a P&L?
I do not. I don't do a balance sheet. I mean, essentially the net wealth calculation is the balance sheet, right? The net wealth calculation, when we talk about balance sheet, what a balance sheet is a financial statement. And businesses have 2 financial statements. And you as a person also have 2 financial statements. And what they teach you day one in any kind of accounting class is that you the business have an income statement which is representative only of a moment in time, and the balance sheet of any company is the accumulated health of the business. So if you think about a business, any business, you can have good years, you can have bad years. So your income statement one year may show a negative or it may show a positive. And then in another year, it might be way healthier, but the balance sheet shows the accumulated effect of all of those years every single year. So that's what I'm interested in, and that's what we're looking at, right? So when you ask, do I keep a balance sheet? When I keep a balance sheet, really, huh?
What's wrong with Lucky?
He's got a hairball, I think. Sorry. But the balance sheet for me is this net wealth calculation.
That was a cat thing. Dog thing.
It might be a lucky thing for today. Sorry, guys. But yeah, so do I keep a balance sheet? No, but the net wealth tracker is your balance sheet because it's all of your assets minus all of your liabilities, and that is your net wealth. Does that make sense to everyone? If it's new to you, that's the point of the mastermind. So I'd love to chat about it further. Okay. So Tyler asked what else we could use to track net wealth. I'm going to share the screen just momentarily so that y'all can see what I'm seeing. So I pointed you guys on the Facebook group to a website called My Money Wizard. And this guy was simply tracking his net wealth. He started in 2015, and he made an online blog of tracking his wealth. And he's held himself accountable publicly, which I think is really pretty neat. And you can see he does a blog entry. These are linked to blog entries every single month. And you can see that his net wealth mostly improves every single year, right? And what he's using to track his net wealth is this free net worth tracker. And I did a little bit of research on it. So this tool right here is called personalcapital.com. And apparently you can use this platform that's pictured here on the right to track your net wealth. And the way that they do it is you can opt in to link credit cards, bank accounts, any kind of like 401k accounts that you have, so like Fidelity, Vanguard, Edward Jones, any others that you could tie them to this website. So it auto populates the value, and then it gives you a running graph of what your wealth is doing on a monthly basis. I think the way that this entity here, personalcapital.com, I think the way that they make money is that they offer the things pictured here, which is wealth management, private client services, investment methodology. So I think that they are offering you a tool for free, so that if you wanted to opt into some of their financial services, you could. So if you are comfortable with tying your bank accounts to a website like that, then I would say that would be a cool way to go about doing it.
Do you know how secure that is?
I actually was in the process of researching that because it kind of makes me nervous personally, but I'm also way more hawkish than the average bear. So
my wife's listening in, and that was her question.
Yeah, no, it's a great question. It's the first one that popped into my head. I hit, I think that's About Us is where, do you see the security portion right here? Yeah, so I mean, we could take a look at it and see what they say. Keeping your account safe, we have your best interests, includes never selling your data.
Yeah.
But then it says, and when we share your data with third parties, but not sell it, we're just sharing it. That's interesting. To help deliver our services, we make sure that they don't sell your data either. After all, nobody wants their contact information stolen. We all know that when it comes to security, you can't rest on your laurels. We believe in constant testing and improvements. It just seems kind of vague, honestly. Strict internal access, strict access controls. No one at Personal Capital has your credentials. Data is encrypted with multi-layer key management with rotating user-specific keys. Yeah, so I don't know, Bob. It makes me a little nervous, but I have to probably do a little more research there. What is the group?
You could just take the information and create your own spreadsheet from it.
Yeah, I mean, no one's hacked my Excel spreadsheets yet, so I've been pretty comfortable with that so far. It is a little more tedious, right? Because you gotta look at the balances of any cash accounts that you're holding and fill those out. You gotta look at the balances of your mortgages and fill those out. Your car notes and fill that out. Student loans, you know, any kind of recurring debt. So you would have to log into those accounts and get those balances and then throw them into the spreadsheet. But it's served me well so far. I'm gonna stop sharing. Questions on that so far? Comments, concerns, ideas? Okay. So when we talk about the asset side of the balance sheet, there's two parts to net wealth: everything that you own versus everything that you owe. And in my experience, one of the fastest ways to improve your net wealth is to invest in appreciable assets. And what worries me around the language that's used in real estate is that people will very oftentimes throw around the phrase, "Well, this is an investment." If you've attended any kind of seminar or paid class, they'll often say, "Well, this is an investment." You know, well, yes, education is an investment in yourself, and strictly from a financial standpoint, when that money leaves your hand, it is very oftentimes simply an expense, right? And so because the language gets kind of vague, I do want to touch on what an asset is and how we classify those assets. Okay, so assets in general are items that hold value. They are things that you own and that you can easily point and assign a value to. Now, assets are one of two types. They either appreciate, meaning they improve in value over time, or they depreciate, meaning they decrease in value over time. Okay, so an asset is also something that can be an investment. So an investment is a type of asset, and what an investment is something that actually returns you money over and over and over again, right? So in the Keller Williams kind of lingo, you hear every time that we're doing a class, they call it an investment, because the bridge there is that you would take the education, use it to make more money, and of course then the education has a return called your new income on the investment that you've made. But in the strict sort of conversation of net wealth tracking, an investment might be like a stock that you own, and that stock improves in value. Sometimes it lowers in value. But oftentimes, what you'll invest in is not only the stock that's improving, but the stock will then pay you a dividend, right? So that's a return on that investment. So all of those things are assets. And the part that I want to challenge people to get really very familiar with is mentally testing yourself on when you spend money and you think you're buying an asset. First, is it appreciable or is it depreciable? So if you're justifying a higher expense on something because you say it's an investment, the question I want you to ask yourself, is it really an investment or is it a depreciable asset that's not returning you money? Okay, you could have a depreciable asset that returns you money. Like if we were running a manufacturing company, we could have machinery. Machinery depreciates because it breaks over time, but that machinery makes the stuff that makes you money, right? So a depreciable asset, the one that comes to mind in real estate most commonly is the car. I'll hear people say, "Hey, I went and I bought this swank, really cush, what do you call it? Like the Mercedes GLE something or other, and it's super fun to drive and it's awesome." And they'll call it an investment. A car is like textbook definition, not an investment. It is a depreciable asset that's worth less over time, right? So the thing that I want to challenge everybody on is that when you choose to spend money, which is important to do, when you choose to let go of that cash, are you trading the cash for something that will actually improve in value? Or are you trading the cash for something that will decrease over time? Okay, so when we let go of cash, that's the first question that we ask ourselves. how are we going to make the cash that we've fought so hard to earn grow into something that creates a bigger balance than when I started. Okay. So that's the first question I want you guys to really come back to every time. How has that shown up in y'all's lives or in your experiences so far?
Well, I do really look for stocks that do give dividends, so that I have, and I reinvest the dividends into more stocks.
That's right.
So it continues to grow. And I've really, in my late stage in life, have really tried to concentrate on that, so that I have another stream of income. So if you continue, dividend paying stocks and dividend paying stock. What am I trying to say? Mutual funds.
Mutual funds.
Mutual funds, but dividend stock mutual funds. Because that's another stream of income. Because in 10 years, I'm hoping that's providing me $1,000 a month in extra income, and I'll stop reinvesting and just let it pay me.
That's right.
But I still have the stock.
Yeah. So if anyone's new to the concept that Bob's talking about, if you were to contribute money into any kind of mutual fund, the mutual funds are usually desirable because they will say, hey, not only does the share price improve on the mutual fund, but quarterly we'll pay you a dividend. So if you own 100 shares and they pay a dividend of $2 per share, you just earned an additional $200 just for having owned 200 or 100 shares. And then the option that these mutual funds will give you is they say, hey, do you want to cash out those $200, which you'd pay tax on, or do you want to reinvest it into buying more shares? And the answer always for retirement accounts is, I don't want to say always, but let's say always. The answer is to reinvest it, because now you can buy more shares. So let's say it paid you a $200 dividend and that let you buy 10 more shares. Well, the next quarter comes around, you own 110 shares. They're going to pay you $2 a share on a dividend that quarter. So now you receive $220. Now you take those $220 and you reinvest it, and on and on and on it goes. And so that's how that true equity gain really starts to pick up, to where your net wealth doesn't just feel like like your net wealth is not just dependent on you earning more cash. The selections that you've made for the investments that you have are doing the work for you, right? Well,
and another reason that I like that plan is because interest rates are so low in bank. Well, compound interest is harder. Compound interest, using it as a dividend, considering that as interest, it works beautifully.
It really does. It really does. So like what Bob's saying is that, let's say the stock improves by a couple of percentage points every year. Let's say the stock improves by 4%. Well, 4% by itself is not really a huge return for the risk of holding a stock. But if the dividend payout is 2% or 3% itself, now the return on your investment is 6 or 7%, instead of it just being one or the other in isolation. So when you look at it together, it makes more sense then to own the stock. Is that what you're referring to, Bob?
I had to unmute myself. Yes, that's exactly what I mean.
Okay. So again, if we go back to the asset class, we're talking about cash. Cash sitting in the bank earns you maybe 0.001% return. Good to have. We keep a lot of cash because it's a risky business that we're in. So you'll hear traditional wisdom say, hey, keep 3 months worth of cash on hand. I would challenge you to say real estate agents should probably seek to have 6 months of cash on hand. And if you can push it a little farther without it getting out of control, like where you're holding on to too much, maybe you have a little bit more squirreled away for an emergency fund or some kind of bucket that you're going to invest that cash in the future. So cash earns you 0-ish% if it sits in the bank. A certificate of deposit, or what you hear called a CD or a bond, those are financial instruments essentially where you give the bank your money. You say, hey, I got all this cash sitting in the bank. I'll throw it in a CD or a bond. And that's a contractual obligation that you have with the bank. And the bank says, hey, thanks for your $10,000 that you just gave us because it was in your savings account anyways. And in exchange for you giving us that $10,000 for 1 year, 2 years, 5 years, or 10 years, we'll give you anything from 1.5 percentage points to maybe 2.5 percentage points, right? Bye, Sheila. And that's better than it sitting in the bank, but it's not really returning you a whole lot of money. So then essentially the higher risk investment that you choose to put your money into, usually you should expect a higher return. So a stock is obviously dependent on the company and the performance and condition in the market. So because you're risking more of your money, you would expect a higher return. Now, the most obvious one for us to talk about as real estate agents are houses. Houses tend to be very secure investments. They tend to be very appreciable investments. I did an investor series that I can link back to in the group if you guys want to chat about it. But in the very beginning intro video that we did, we talked about why would you invest in real estate, right? And let's talk about just your home for a second. Your home by itself, according to the National Association of Realtors, improves every year by 3 to 5% every single year on average. That's accounting for pandemic. It's accounting for pandemic. It's accounting for hurricanes, natural disaster of any kind, economic disaster. That it's 3 to 5% a year. Your house is also probably one of the safest assets to have because it's forced savings, meaning you would have to sell your house in order to get to the cash or the equity that's in your house, right? So because it's harder for people to get their hands on it, it tends to appreciate, or the returns tend to be greater once people actually do try to cash out. You're not really necessarily going to pay a lot of tax on the cash out of your home when you sell it if it is your primary residence. So that's another huge benefit. And then the other part is that if you put a mortgage on your home, you know that every single month when you pay that mortgage off, a portion of the debt that you owe on that house is reducing. So that's also improving your net wealth. So every mortgage payment that you make, your house is improving in value because markets do that, and you're also reducing your debt. So that's why real estate is a really great place to start in your asset portfolio. And so somebody asked on the last call, they wanted to hear about, why we chose to invest more in real estate. And it was because we really felt that we had put enough money into the stock market, between the Roth IRA, the SEP IRA, and Andy's 401k. All of that money is in equities, mutual funds, stocks. And so we had available cash, and we said, well, where else can we invest it? We could have put it in life insurance and other type of stuff, but really it was like, well, I deal in real estate all the time. I'm afraid of having tenants, but I wanted to invest in real estate, So when you invest in real estate, now you've got another real estate investment that's improving in value. Someone else is paying down your debt, which is improving your net wealth because you're not even paying that debt and your debt balance is going down every single month, right? And then you're also receiving positive cash flow. And that positive cash flow every single month is money in the bank. Now you have to resist the urge to then go spend that money. Hopefully you choose to reinvest it. But when you look at home ownership, we've got 3 to 5% appreciation every year. When you look at debt reduction, if you were to pull up a debt schedule or the amortization schedule on your house payments, realistically, you're reducing your debt by 1 or 2 percentage points every year because they collect all the interest from you up front because they're the bank and they always win. But you're reducing your debt, let's say, by 2% a year. And then if you've got cash flow on that property, that cash flow, let's say you earn $200 a month, positive cash flow times 12 months, you've got $2,400 on a $200,000 investment. We're talking about a 1%-ish return, maybe a 1.5% return. So 3 to 5% by itself isn't overly compelling. A 1 or 2% reduction in your debt by itself isn't overly compelling. 1.5 to 2% positive cash flow return every year is not overly compelling. But when you add them all up, we get closer to 8 to 10% appreciation and debt reduction, or your return on your investment. So it's improving your net wealth essentially by 8 to 10% a year, which is bang on for the advice that you receive from a financial advisor, which is that, we're going to target equities or funds or whatever that return you somewhere between 6 to 10% a year. So those are the things that we look at and consider when we're saying, okay, what is the best way for us to leverage the cash that we have that's earning $0 into income producing assets or into income producing stocks, right? Thoughts, questions, feelings?
Yeah, I got to be in a room with Mo Anderson years ago, and she asked everyone, it was full rooms, like, how many of you guys have money in the stock market? 50, 60% of the room raised their hands. And then she said, how many of you guys have money in real estate market? Maybe 3% raised their hands.
Yeah.
It's like, shame on you guys. And in my past life, I was a futures trader in Chicago. So I really knew, I was really tuned into that. I don't touch it because I'm not tuned into it. And what Mo said was, hey, you're realtors. Your advantage is in real estate. So if you don't have money in real estate, I mean, you're going to know everything first before anyone else.
Yep.
You're going to find the deals.
That's just it.
Yeah.
You're totally right. And I was very, very, very afraid to do it, honestly, because I went to a seminar with Wendy Papasan for KW Young Professionals. She was in Houston, and she came to talk about real estate investing. I really wanted to hear her talk because that's something that she's really involved in or tuned into, like you said. And she asked the same question, so she must have taken a page out of Mo's book. But I volunteered, like when she asked, who hasn't invested in real estate and wants to, I raised my hand. She said, well, why haven't you? And I said, my daily life is my income's earned in real estate. We already own a piece of real estate. I'm afraid to tie more money up in real estate, right? And she asked the same questions that you just did, and she said, every great deal will pass through your hands first, and that really kind of made me stop and think. And then she kept saying over and over again, to be afraid of the debt is understandable, and remind yourself that the tenant is covering your debt. Can you handle 2 or 3 monthly payments, for vacancy? If you had vacancy, if the answer is yes, then do it, because the tenant's going to pay your debt every single month. And that was really what I needed to hear, and it hit me in a different way. But yeah, I mean, you're exactly right. If you're tuned into it, it's less scary, and I think it makes sense.
Yeah. You'll know when it's a good deal, mm-hmm. and you'll find the money to make it happen.
So we were talking at family reunion, and you said you had the one that you had picked up in 2008, 2009, right?
Yeah.
And you still have that one, right?
Still have that one. Just put some new piers in it, so that was fun. But
yeah. The assets do cost you money.
So that was a good deal because we bought it for $160. It was a VA Vendy, which Bank of America at the time was unloading all these VA properties that they had basically had, the government gave them. Mm-hmm. And so they were kind of doing an assumable loan, but they didn't say it that way. But for an investor, you could get in with a 5% down payment, mm-hmm. and a 4% interest rate.
That's amazing.
Yeah, I got a $160,000 home for $8,000, and they paid my closing costs.
That's incredible.
Wait, can you repeat that last part?
$160,000 home. This is in 2008 for $8,000 down. I owe $130 on the house on the note, and it's probably worth $220 right now.
It's amazing. So it's $90,000 right there.
Yeah. So before all the repairs, I probably put $8,000 down payment, another $3,000 in updates. So that's $11,000. I had a 90% or $90,000 appreciation. Mm-hmm. So
Yeah, I mean, the assets are going to cost you, right? You're going to pay somebody for something.
Yeah.
I mean, it's kind of embedded in there, and it does reduce your cash. So arguably, if you're trying to mentally account for it, your positive cash flow essentially saved over time helps pay for the repairs that you got on the home, right?
Yeah, and the reason was when I had my first daughter, I'm like, I got to get her, I got to create a college fund for her.
Mm-hmm.
So that was, and college is almost like hyperinflation right now. So you can't keep up with it with a normal investment. So this was an opportunity to do that. But if you,
really
again,
think about it.
Yeah, again, and then share that with your young couples or past clients that have just had young ones. Here's a way to keep up with the cost of inflation. Have you thought about investing it into property? At the very
write that one down.
Right, do it. I could see you doing a great little seminar on that. At the very least, it's another touch and another conversation.
I love it.
So go
future education, yeah.
Yeah, go make some babies, Carolyn, and then tell all your babies' friends.
Great.
Yeah.
I found 6 people, I think, that are pregnant.
Oh.
That I've done with all these care calls through coronavirus.
Oh, Corona babies.
Mm-hmm.
All right. Have that.
I don't even think it was like, intentional Corona baby time. I think it was just like we're all 32 or 33.
Yeah. But have that conversation with them. Hey, think about start stockpiling some cash. What's your plans for college for your children?
Yeah, I love it. That's really smart.
Yeah, because then there's a couple options. In 18 years, you can, that can be paid down on that house, and so you're just making positive cash flow if you do it right. Or you sell off that asset, hoping that it appreciated, and with what, at maybe 20% down, and that 20% down then becomes, whatever that asset is worth.
Right.
So those are some options.
No, I really like that a lot.
And if they decide not to go to college, what happens? I don't know the answer to this. With those college funds that people buy into for the state, where they,
aren't those called 529 plans?
Yeah. What happens if the person doesn't go to college?
Actually, don't know.
Okay.
Does anyone on the call have a 529 plan?
Yeah, it has to.
We used ours.
Okay.
On our kids, I mean.
On a beach house. Yeah.
You have to.
It has to be used for education. You can gift it to someone.
In the state of Texas, I believe you have to use it for a school in the state of Texas. You might have to watch those 529s. They have some restrictions.
Yeah, I do know some of them restrictions.
To college, to another state, you might not be able to use that fund.
I know you can use it for trade schools too.
Okay. Yeah. Or like culinary school.
So if your kid wants to become a welder, he can use it for that, for welding school.
That's good.
That's good. That's
it just seems like if you saved up, let's say $100,000, and welding school costs 20, what happens to the 80? Are you allowed to redirect it, or do you pay tax on that money if it comes out?
I think you can only have it's an after-tax deduction, so you don't deduct it as you put it in the account. I don't believe you need to check on this for me, Carolyn, because I'm not 100% sure on that. But I think it is after tax. So basically, what you're getting tax-free is the gross.
Okay, I gotcha. The growth. Okay.
I am curious what happens to that if they just choose not to, or heaven forbid something happens and there's college isn't an option for that person.
Mm-hmm.
It was our understanding that you had to use it for education, and you could open it up in the name of your firstborn. And then if you had 2 more children after that, it could be spread among the children because you then gift it. If it was not used, you or your wife could use it for education purposes, or you could gift it to like a niece or nephew. But it is my understanding that they're very restrictive and it is earmarked strictly for education.
So that might be,
That's one of the reasons we chose not to use them.
yeah.
Civilization.
When you do your pros and cons for your presentation, Carolyn, that would be one of the cons.
Yeah.
While real estate, you have the flexibility.
Yeah, totally.
Okay, so my wife looked it up. So
Oh, we lost Bob.
You were getting to the good part, Bob.
qualified families such as younger siblings, nieces, nephews, grandchildren, or even yourself.
We only heard grandchildren and even your.
We are having internet problems in my household.
Sorry, Bob.
Basically, you can use it for all your relatives, including yourself.
That's good.
But I don't want to get an MBA when I'm 60. I'd rather get a beach house.
If you're contributing after tax money, it would seem to me that you could take it out after, without taxable consequence, but you might have to pay tax on the gain. That's what I would think.
Right.
I don't know.
So one thing Jason and I did, we did not do the 529. We did a grandparent policy through our insurance company that we did on the boys, and we did 2 separate ones, so they have 2 each. Is what we decided to do so that they can keep one for life and keep one for, it's a paid up policy on both of them. However, one they can, take it out and use it for college. Was what we did. So we didn't have all those stipulations of the 529.
I just love the idea with the house. I think that's really very smart.
Oh, it's genius. However, at the time, that was the easiest way because we had a lot of student loan debt.
Mm-hmm.
So, it was a inexpensive way to take care of them. However, I do agree, real estate is amazing if you have the down payment and have everything in order.
Sure. So we've spent a good chunk of time talking about the asset side of the conversation for net wealth. I do want to just touch briefly on the liability side of the conversation. So we have to take everything that we own, our assets, and subtract off everything that we owe, which is our liabilities. And I think it's some fear around that sometimes, like taking inventory of the debt that we owe. I think we touched on this on the last call briefly, that maybe there's hesitation to run these calculations at all if the number is actually negative. You may find out that your net wealth is currently negative. And there's 2 major types of debt, or 2 classes, I would suppose. And one of them is going to be your amortized debt, and the other is going to be high interest bearing debt. So the amortized debt, you tend to hear the phrase thrown around as good debt. And that's going to be your car note, and that's going to be your house note most commonly, because amortized just means that the interest has been embedded into every single payment. It's fixed, and your payments don't change. Now, the banks are sneaky about it. So you all know that as soon as you start paying your house note, like 2/3 of that payment goes towards interest, and generously 1/3 goes towards the principal. And over time, as you make it through that payment schedule, maybe 12, 13, 14, 15 years later, you hit that break-even mark where your payment to your interest and your principal are equal. And then finally, your payments start to veer more towards paying off the actual principal instead of just paying interest. But remember that the bank always wins. So amortized debt's great because the interest tends to be low, and the payments don't change. So it's something that you can plan for, and it's something that you can account for. And it's usually in the name of getting something that is necessary in your life, like housing and transportation, right? And then the high interest debt, that's usually a debt that's going to be offered to you with a minimum monthly payment. And this is where things can get dicey, and it can turn into a slippery slope. So credit card is probably the most obvious high interest bearing debt. If you think about house interest in today's market being somewhere around 3%, 3.25%, or historically, I think the historical average on a house note is like 6%. In credit card debt, we're talking about somewhere between 18 to 24% is how they advertise that. Am I right on that? Does that sound right to everybody?
Say that again.
18 to 24% on credit card debt.
Yeah, that sounds about right.
Yep.
Yeah. So the credit cards make their money. They say, yeah, charge whatever you want, and we're gonna offer you a monthly payment, which usually is 1% of whatever you charged. So if you charge $3,000, they'll say, great, you only have to pay us $30. Well, bad news bears, the rest of your $2,970 is accruing interest at a rate of 18 to 20 to 24%, right? So that's how those credit card balances can really get out of control, which of course is a chain around your neck on trying to get out from underneath that. It can be suffocating. Andy's student loans, if I'm remembering this correctly, were not amortized. And I think they were at 6%, some of them were at 6%, some of them were at like 7%. And I feel like our balance grew every single month unless we made more than the monthly payment. So I'm fairly certain that student loans could veer into the type of high interest debt that we're talking about, depending on how big that principal balance is when you start. So those are things that can be a little bit hard to get in front of. And then you've got things that you can opt into for other vehicle, or if you went and bought a boat, or if you had seller financing, or if you had other things that you're trading a special set of circumstances for someone else's money. Those are the things that usually can bite you in the rear. So when people have asked in the past, they say, well, hey, would you pay off all your debt, or would you just try to put that money, would you invest? And my questions always go back to, what's your highest interest bearing debt, and what do you feel you need to do to both pay, get a handle on that that's beyond the minimum monthly payment, but then to also take the opportunity to reinvest that money into an asset that will grow over time, right? So what are y'all's thoughts around all that? Thoughts, experiences, or concerns?
I did the Ramsey debt snowball years ago, and that was helpful, just getting all that debt paid off. And then talking about depreciating assets, yes, it's a good reminder so I don't go buy the car I want to buy.
It's hard to control that impulse though, isn't it?
Yes. I don't like buying cars, so I'm going to hold on to the one I have.
I don't like buying cars either, as evidenced by my 8-year-old Honda. What other thoughts or concerns around the debt portion of the conversation do y'all have? Nothing?
Maybe talk about some business debt specifically, like as we grow our business, hiring an assistant, paying office rent, outsourcing things, transaction coordinating services, sign services, I guess leverage, and how that relates to the terms expenses versus investment versus leverage, et cetera. Does that make sense?
Yeah. So I would say the decisions that you're making to spend money in a business, hopefully, we're looking for at least, if you're choosing to part with, $4,000 a month on an assistant, you would expect that the time that the assistant's saving you would lead to at least an additional $12,000 in income that you would be able to generate, or a three-time multiplier, or your return on investment would be 300% essentially. So it would personally stress me out to take out a bank loan or like true debt to go hire an assistant. But I do know that there are folks that maybe chose to do something like that with the PPP loans that we got from the SBA. They might have taken those loans and then chosen to go and invest that into talent. If it's done not the right way according to the SBA standards, and that really could become true debt in your business. But generally speaking, I would say if you're making decisions on spending money or parting cash in the investment, recognize that office rent truly is an expense. Supplies truly are expenses. They're not going to return you a traceable value. But human capital, your assistant, your buyer's agent, your transaction coordinator, all of that is in the spirit of freeing up your other resource, which is intangible, called time, right? You've got an hourly rate. That time is worth something to you. So if you're paying someone 40 hours a week at, $15 an hour, surely each hour spent that week, what's the math on that? Is that $600 a week? Yeah. Surely that week's worth of work that they invested will return you more than $1,800 that you were able to go develop in either potential business or written contracts. Does that answer your question, Linda, or am I barking up the right tree?
Yep, absolutely.
Yeah. Did anybody on this call get a PPP loan? I got one.
Yeah.
You
I got one.
Yeah.
Yeah.
Yeah. So if you got an EIDL loan or the EIDL loan, my understanding is that really is a true loan where it's got a repayment schedule. The PPP loan came out after, like a couple of weeks after the EIDL loan, or at least it became available to self-employed individuals after that. And the PPP had the provision where if you use the money to spend it on salaries or the equivalent to what your adjusted salary was as a self-employed person, then X percent of that would be forgivable. So it's more like a grant and less like actual debt. Yeah, but I would probably strip a gear mentally if I took debt and went and paid somebody with it. That would probably stress me out quite a bit.
Let me know later how you decide to repay it or how they ask you to repay it.
Bob, did you get a PPP loan?
I did not.
Raquel, did you get one?
Yes.
Okay. So our bank just released a standardized loan forgiveness application, and it's just a straight up formula. So when I talked to the banker, what she said was that they were going to have their own internal underwriters decide the forgiveness conditions based on the guidance that came from the government. And so our particular bank literally just has a formula. How much money did you give yourself out of that loan? How much did you spend on, approved expenses? And then it's got a multiplier on it, and it says how much was your loan, and the lesser of the two is forgivable. So it was very, very cut and dry. Now, it did say that applied to anyone with a less than $2 million PPP loan.
Right.
So it's kind of like a safe harbor, I think.
Okay.
But I was expecting to have to submit crazy documentation, but it doesn't look like it's going to be that way.
No, they made it pretty easy. I was kind of shocked.
Yeah, and I think the banks were all pretty scared about whether or not they were going to be held to like fraud or investigations or any kind of misuse of those funds, right?
Yeah.
Yeah. But it is rounded on an hour for our call here, so I just wanted to respect y'all's time and see if there's any parting questions before we sign off for today. Thoughts, concerns? Was this valuable to you?
Well, same time next week?
Goal is to do this twice a month or once every other week. So I guess some months 3 calls, some months 2 calls.
All right.
Has this been valuable to y'all today?
Very.
Good.
I liked it. I got some notes.
Good. Me too.
And Jason had to drop off.
Yeah, no, he's good. I'm glad that y'all could be on the call today. I really appreciate your participation, and I really appreciate the thoughts. This is turning into exactly what I hoped it would be.
And
So July 3rd is our next one?
Well, July 3rd would be next Friday. Does that work for everybody, or should we do it?
That's 2 Fridays.
Yeah. Does that work for people, or should we do it a little earlier in the week in the name of the weekend?
Yeah.
Weekend?
We're realtors. We don't get a weekend.
That's
I was just thinking the same thing. I'm like, no.
Okay. All right. Well, then we'll set it up for July 3rd then.
All right.
Okay.
Well,
Thank
thank
you,
y'all for being on the call.
All right.
Bye.
Thanks, Carolyn.
Bye, y'all.
Bye.